Michael, are you there? Michael Porter, are you there? Nicole Picard, can you hear me? Nicole? Oh, there he is.
There I am. Can you hear me?
Yes. Could you hear me a few seconds ago?
Yes, I could.
Okay.
Okay, so let me kind of move this stuff around and see. Let me get some cancer.
Okay. Do you have a light in there? Because I can barely. There we go.
Let me turn all the lights on.
There you go. Much better. Much better.
I had to just move. If for some reason I have to have this turned just so.
Awesome. You're looking awful sharp there, Mr. Porter.
Yeah, well, you're just seeing the top. You're not seeing the bottom.
That reminds me of a commercial I saw. A guy thought it was a Zoom, and he walked to where his wife is in his skivvies. So
whiteys, I saw that.
Just don't stand up, my man. You're good.
That was hilarious. Hilarious.
Yeah,
I like that.
That's our.
Okay, so my video's up. The sound is up. I see that there's a mark here on the screen. Should I click that?
Only if you want to share your screen in terms of a presentation or go to the internet or something like that.
Okay, if I click that, then that's the sharing deal. There might be only one thing that I would share. But,
right.
We'll when we get there, I may or may not do that. I might just keep all of this into the conversational stage.
Okay.
And I even got a little bit more than what we talked about on Saturday.
Yeah.
Yeah.
Well, it's going to be good stuff. I know that much. I know.
Yeah.
Good stuff.
Well, it's 11:26, so we're 1 minute into it, right?
Right. Well, I generally give them everybody a couple minutes. There was another session going on. It's probably ending up now. Mm-hmm. So probably at 27 or so, 12, 27 or so, we'll get it rolling.
Yes, sir.
Okay, so we're going to go ahead and get started. My name is Larry Brown. I am with the Ohio University PTAC, or Procurement Technical Assistance Center, and I will be your moderator for today. So I'd like to welcome everyone to the We Mean Business, which a CPA will tell you that QuickBooks won't tell you. And so we'd like for this to definitely be a engaging session. And so please put any questions that you have into the chat box, and we will get those answered for you. And one of our additional goals today is not only answer your questions, but also to have you have some actionable items that you can take away from today's session as well. So, got a lot of feedback there, Michael. Okay, that's much better. Thank you, sir. So, I'd like to tell you a little bit about today's speaker, Mr. Michael Porter. And Michael Porter is a CPA and certified financial planner for over 35 years of experience and as a CPA and 15 years as a certified financial planner. He began his career with the CPA firm KPMG and worked for a major financial institution, serving various roles ranging from vice president, special projects, to executive vice president, chief financial officer. He also worked for an international investment company and had several projects in both Russia and China. In June 2018, Michael accepted a position of broker director with Mass Mutual, where his role is to find independent agents willing to work with Mass Mutual via a BOPA contract. Michael was offered and accepted the position of managing director for Mass Mutual in June of 2019. He continues to maintain his accounting practice and combines financial planning advice and strategic tax planning for all his clients while working with a team of advisors to utilize his skills with their clients as well. You guys are in for a treat today. Make sure you have your pen and paper ready. He's going to be really dropping some knowledge. And without further ado, I give you Mr. Michael Porter.
Good morning, everybody. So the topic of my talk today is what a CPA will tell you that QuickBooks won't tell you. And I thought about this a lot, and I thought about it when I was reconciling one of my clients' bank accounts to QuickBooks. And I started to make this really detailed, but I thought I'd just go ahead and get into some broader subjects. One of the things that that QuickBooks won't tell you is how to pick a legal entity. There are several types of legal entities or entities that you can structure your company by. And I want to go through a couple of them, and I'm going to give you my opinion as to which one I think is the best. Obviously, the quickest and easiest way to start a business is to have a sole proprietorship. Sole proprietorship is relatively easy. You just start business. You pick a name. You might go down and pay $15 and get a DBA. But essentially, a sole proprietorship means that you have total legal liability in that situation. So whatever you do or whatever happens within the company is going to be a reflection on you personally as well as from a business perspective. If you want to get a little protection, you might consider a limited liability company. And in the language of or the title of that type of entity, limited liability company is right there. You have to register with the state that you're in. Generally, it's relatively inexpensive, about $300 or $400 if you do it yourself. Quite a bit more if you let an attorney or somebody else do it. But a limited liability company is another simple entity, but what it does, it segregates your business from your personal assets, and it allows you somewhat of a limited liability. The next type of entity is called an Escort. An Escort, and I think a lot of people don't really understand what an Escort is, but an Escort is essentially the same as a C corporation. A C corporation is like your Microsofts, your GMs, and things like that. They are legal entities. These type of entities actually pay taxes. And according to a lot of the political language out there, a C corporation, they can do things like a live person. Well, an S corp is a little different. the way that you create an S Corp is you literally create a C Corp and then you petition the Internal Revenue Service to treat the entity as an S Corp. An S Corp, unlike a C Corp, does not pay taxes. An S Corp is what you call a pass-through, the same as a limited liability company. In other words, whatever that entity does passes through to the owners. Okay? Now, what is the difference between a limited liability company and an S Corp? An S Corp is formal. If I ever had an issue with someone who I knew was structured as an S Corp, the first thing that I would do is subpoena the corporate records. And what that means is that, you have to have that entity structured in a way that denotes that you're doing everything from a legal standpoint to make sure that it is operated correctly. You have to have a board of directors. You have to have board meetings. Those board meetings have to be memorialized with minutes. So if you create an S Corp and you don't go through the process of having a formality of a real legal entity, someone could go in and pierce the corporate veil and literally get at your personal assets. So if you're going to do an S Corp, you have to understand that you have to play by the rules. All right, so what do I recommend? Because an S Corp is so difficult to operate and a limited liability is less so, my recommendation would be to do this. Create a limited liability company and then petition the Internal Revenue Service to tax it as an S Corp. And it's very simple. Well, I don't want to say too simple because I'm going to make a lot of CPAs and a lot of lawyers angry by saying that, but it is simple to do. All you do is you go ahead and form your company as a limited liability company, and then you file what they call a 2553 document where the owners of the limited liability company are requesting that the Internal Revenue Service treat the entity and tax the entity as an S Corp. Why would you want to do that? A couple of reasons. If you own a limited liability company, you really can't pay yourself a salary. Literally, all of the income created in a limited liability company goes to the members of a limited liability company. Let me give you an example. Let's just say, for the sake of argument, Larry and I have a ownership of a limited liability company, and it made $1 million. After all the expenses, it made $1 million. He owned 50%, I own 50%. We would both get what they call a K1, which is the recognition of the income that we earn from our limited liability company of $500,000 each. Now that $500,000 would be taxable for federal income tax purposes, and it would also be subject to self-employment tax. And the self-employment tax that we would pay on that limited liability company would be twice the amount that most people pay on a salaried job. For instance, on the Social Security, where you pay 6.2%, the self-employment tax is 12.4%. Where you pay 1.45% for Medicare, the self-employed tax is 2.9%. So you're literally paying, but the 6.2% of the 12.4% is limited to the maximum dollars amount that you pay on Social Security, which I think this year is about $137,000 plus dollars. The Medicare tax is paid on the entire amount that you earn. Okay, so that's what would happen with the limited liability company. Let me change it a little bit. Let's say we had an S Corp and we were being taxed as an S Corp and the company made that same $1 million. Only this time, Larry got paid $350,000 and I got paid $350,000 in salary. So we had $700,000 of salary. And I'm not going to get real detail because I don't want to major in the minor here. I just want to just kind of get the gross numbers. So let's just say that after both our salaries were paid, the S Corp had $300,000 of income left. I know it's not quite that number, and I hope there's no CPA on the line because they're going to correct me, but I'm hoping that you all aren't CPAs, all right? So the $300,000, again, is split between us. He gets 150 and I get 150. Now, we pay taxes on the $700,000, the 350 that he got in salary and the 350 that I got in salary. But that $300,000 where he got half and I got half would not be subject to self-employment tax. Let me repeat that. That part would not be subject to self-employment tax. So that's one of the tax benefits of being taxed as an Escort. And the reason that you set up an LLC and then petition the Internal Revenue Service to tax your entity as an Escort is you're getting the benefit of both worlds. LLC does not require that you have a board of directors and you have board meetings and you have minutes and all of the formality of a real structured entity. However, having it taxed as an Escort gives you all of the benefits that an Escort has. In other words, if you have net income after and you can pay yourself a salary even if you're an owner, the net income that remains is not subject to self-employment tax. Now you got to be careful. You got to be careful because if you don't pay yourself a reasonable salary and what you're trying to do is take maximum advantage of not paying that self-employment tax, the Internal Revenue Service may come knocking. So be careful. All right. That's one thing that QuickBooks won't tell you.
Michael, I have a couple quick questions for you.
Go ahead.
Okay, so the first question is from M. Rogers. Can you change entity status after doing business for 2 years from a sole proprietorship to an LLC?
Absolutely. Yes.
All right. That's a quick and dirty right there. All right. Yep. Second question from Alana Stockard. If an LLC has existed but not done any business until 2020 and is a small business with sole proprietor, can a petition to be taxed as an S Corp, is that still plausible?
Yes, it is. And all you have to do is explain when you get the form 25, there's a place on it where you can explain what you're doing and why you didn't do it immediately. Normally, you want to do it in the first year for that the taxes are due. But there is a way for you to get it done, even if the entity has been in existence for a couple of years.
Thank you, sir. That's it for now.
All right. So here's another area where QuickBooks is going to be solid. Let's say you have a partner in your company. I want to tell you a little bit of a story because it'll help me explain this next area. When I first started my accounting practice, I started working for these two dentists. They were young dentists, very, very sharp. They started a business together. They were partners. And over time, different things happened in their lives. They both got married during the time that I was working with them. And on one occasion, one of them came into the office and was extremely happy because she was pregnant and she was letting everybody know. About 3 weeks later, she came in and she was very sad because they had been diagnosed with stomach cancer. And the physicians had given her between 20 to 30% chance of survival, but they had to do radiation and chemo, but they had to terminate the pregnancy in order to help her out. Well, she refused that because she wanted that child. To make a long story short, she had the child and was doing well for a while, but ultimately on, what was it? I think it might have been November the 7th, 2008, whenever the election was. She was in a hospital. She wakes up. She asks who won. They tell her Obama, and she says, awesome. And she died that very night. But that's not the end of the story. What happened was, because she was in partnership with another individual and they had not done any planning, the family wanted to, get the benefit of her interest in the practice. So the surviving partner had to obtain a outside service to value the practice, which they did. They valued it at about, I don't know, maybe $500,000 or something like that. And she literally had to pay the family somewhere between $200,000 and $250,000, which she did not have. And so she had to give them, a note instrument. And to this day, that practice is still suffering the negative aspects of that. What could that partnership have done in order to avoid that problem? They could have entered into what they call a buy-sell agreement. And a buy-sell agreement is when me and my partner, and I'm going to use Larry again as an example. Let's say Larry and I start a business, a limited liability company that's taxed as an Escort. What happens is, because we have an insurable interest in each other, we can do what we call a cross-purchase contract between each other. I buy a policy on him, he buys a policy on me, and the policy's value is designed to be equal what our 50% ownership in the partnership would be. And if something happened to me, Larry would be paid a tax-free payment from the insurance company, for which he would be obligated to purchase my 50% interest in the practice. And because of the step up in basis, my family would sell it to him. The basis would be equal to the purchase price, so there would be no gain there. And that entire amount would go to my family to pay for my 50% ownership. Larry would then have 100% ownership in the practice, and he would have been able to finance it with the insurance that he had gotten on me on the date that we started, or close to the date that we started our company. Now, somebody sometimes asks, well, what if I have more than two people in the partnership? You could have, say you had 10 people in the partnership. And the way that you determine, if they wanted to do what they call, a cross purchase, you would have to buy 90 different policies. But there's a way to get around that. You could have what they call entity purchase, where rather than all of the partners buying policies on each other, because the formula for that is, 10 times 10 minus 1, so that'll be 90 different policies if you did it, that way in the cross purchase. An entity purchase says that the company would agree to buy 10 policies on all of the people. If one of the people died, that same situation that I described in my family getting paid would be paid by the company. That interest of that individual that died would go back to the company, and it could either be just kept by the company, and the other 9 owners would now own 100% of the practice, or they could allocate proratably the 10% that was purchased to the other 9 owners, so that now 9 people now are the owners. That's another thing that QuickBooks wouldn't tell you. And the third thing that I want to talk about is tax strategies. If you have your own company and it's pretty successful, the idea is to minimize your tax liability. How can you do that? Well, one of the best ways to do it, especially if you structure your entity like I just told you, and you're paying yourself, say you paid yourself $250,000 of salary. You could set up what they call a simplified employee pension plan, a SEP, and you can contribute up to a maximum of $57,000 into that retirement plan. Now, what the company is literally setting up the plan. So you got to be careful with this also. Let's just say that you have a company with you and your spouse. If you set up a SEP for yourself, you're the owner or whatever, you have to set up a SEP for her as well, or him as well, the spouse as well. Okay? So if you have a company that has a whole bunch of employees, this might not be a choice that you want to make. If you have a company that you literally, I have a lot of doctors, a lot of ER doctors that have done the structure that I just explained to you. They have LLCs that are being taxed as S Corps. They go out and they make substantial money being ER doctors. And what they do is they set up SEPs. Every year, they're making contributions to the retirement account based on 25% of the compensation that they pay themselves. You know, the good thing about these guys, they all applied for and received PPP loans, by the way. That's another subject. That's something that QuickBooks won't tell you either. Now, first of all, before I keep going, are there any questions? Are there any questions about that? Because I got something that's really going to be, I think, a great subject for small business owners.
Michael,
in the next that I want to go into.
we do have a couple of questions.
Okay.
Let's see, where's that first one? Are the meetings with minutes, the requirement for meeting with minutes, still applicable for an LLC change to an S Corp?
No, that's why we want to do it. The LLC has no formality. The LLC is not subject to the same strict requirements of an S Corp. Again, an S Corp is simply the same as a C Corp with the petition to the IRS to tax it as an S Corp, to be a pass-through.
Okay, that question was from Rachel LaFall, and she thanks you for clarifying. Next question is from Alana Stockard. If an LLC embarks on philanthropic work as part of its secondary initiative, should said LLC change its business model to nonprofit, start a foundation, or start a separate nonprofit while maintaining the LLC?
I would do the latter. I would start a separate foundation. I would keep the LLC. I have a number of clients that have done just that. They actually started. I got a guy that started he was a football player for University of Houston. He never worked for anybody. He started a nonprofit. He's doing quite well, by the way. He started a nonprofit, and then he created a for-profit LLC that was that benefited greatly from the nonprofit that he has. But he wanted to keep those separate. You know, you have to basically get the IRS to accept the 501c3 status so that you can give your contributors the tax breaks that they want when they make contributions. But I would keep them separate.
Okay. One more quick question. If a high school student starts a nonprofit, what is the best business structure to have?
Well, when you start, you can create a nonprofit and you can create it the same way I just said, but there are no tax advantages because a nonprofit is like I said, the profit isn't taxable. But you have to, you have special tax reports that you have to do. And you can't do things like certain people in New York did, where you are taking advantage of the nonprofit and doing things that make you realize that it was only for your benefit. And I'm not going to name names. I'm not going to get political. But you can have an LLC that's a nonprofit. You can have an Escort that's a nonprofit.
Okay.
Or you can, like I just said, LLC that's taxed as an Escort, but there's the income isn't taxable.
I'm sorry, one more so that we don't get too far behind with the questions. Can you compare and contrast LLC and limited partnership?
Well, a limited partnership, yes. An LLC has what you call members. An LLC, in most cases, the people that own the LLC, the limited liability company, are actually managing the company. In a limited partnership, what happens is I can be a limited partner, but I have no managerial responsibilities or obligations or anything like that. A lot of people create what we call and you know, there's so many different areas we can get into. You could create like a family limited. I'll give you an example. If I created a family limited partnership and literally put all my assets into the family limited partnership and had the limited partners being my children, okay? Let's say that I gave my children 99% of that family limited partnership. So they own, so I got 3 kids, which I do, and they own 33% of that limited family limited partnership each. And I would own 1%, but I would be the general partner. So I make all of the decisions about the company. So all of the income is going into the family limited partnership. Let's say, for the sake of argument, one of my children get into an accident with a neurosurgeon. And that neurosurgeon finds out that they own 33% of this really fantastic earning family limited partnership, and they sue my child. And they win my child's ownership of the 33% family limited partnership. And the company made $10 million. So my kid would have income of $3.33 million that they lost to this neurosurgeon. And a tax return would be prepared, and the neurosurgeon would get a tax return indicating that he had $3,330,000 of income. But I'm the general partner. So I make a decision. You know what? I'm not going to make cash distributions this year. In fact, I'm just going to hold the money inside of the family limited partnership. So the guy that just won that case against my child has to report phantom income of $3.3 million, pay tax on it, for which he'll never get a dime from me because I'm making the decision. The limited partner has no say in how the money is going to be distributed, only the general partner. That's the difference between that and a limited liability company.
All right. Thank you, sir. Please move forward.
All right. Here's going to be the cool part. Write this down, everybody. You go to irs.gov and type in the search engine family help. irs.gov, type in the search engine family help. Now I'm going to read to you what it says. All right. When you type that in, this is what you're going to hear, and I'm going to explain this in a little bit more detail. One of the advantages of operating your own business is hiring family members. However, employment tax requirements for family employees may vary from those that apply to other employees. The following information may assist you with pointing out some of the differences to consider. Here's the great part. Child employed by parents. Payments for the services of a child under the age of 18 who works for his or her parent in a trade or business are not subject to Social Security and Medicare taxes if the trade or business is a sole proprietorship or a partnership in which each partner is a parent of the child. All right. Here's a tax tip for all of you guys that are very successful in business and paying 37+% taxes and so forth. If you have a child under the age of 18 and your structure is correct, and we got to talk about that a little bit. Let's assume that we've got the correct structure. And you pay that child, say, $12,000, $1,000 a month. You now have moved $12,000 from your maximum tax, and your tax rate is actually around 40%. If you're in the 37% tax bracket and you have your company and you're paying 2.9%, which is twice 1.45% in Medicare, your tax bracket is 40%. So now you've moved that tax, you've moved the payment of that tax. Say you pay your child $12,000 a year. Why $12,000? Because the standard, or $12,400, but we're not going to quibble on pennies. You pay your child $12,000. The child files a tax return. The child states on the tax return that they can be carried by someone else. The child gets a $12,000 standard deduction. And I know it's a little bit bigger than that. So the child's taxable federal income tax, the federal income taxable income of the child is zero. They don't pay any Social Security and Medicare tax because they're under the age of 18. you've now saved approximately 40% of $12,000 or $4,800. You get it? Now there are certain things that you have. I'm gonna hold back a little bit because I want some of you guys to call me directly. I'm gonna hold back a little bit because if I tell you too much, you might get too excited. I even got it. Okay, let's say you have a grandparent, and I was thinking about this. What if the grandparent wanted to do this for the grandchild? Well, the rules are very specific, but here's a way to get around the rules. Here's what happens. So the grandparent talks to their child, who is the parent of the grandchild, and say, look, I want you to create a company. All right. I want your company. I'm going to enter into a contract with your company to provide services for me. I want your company to provide me someone that can come into my company and file and maybe answer the phone or do something, that is going to be beneficial to my company. I'm going to pay your company. Okay. Now your company is going to hire my grandchild, your child. Okay. My company is going to hire your child, who is my grandchild. And they're going to be able to, I'm going to pay you $12,000 for that. So you're going to show income of $12,000 on your company. You're going to pay your child $12,000. Your taxable income, my child, is zero. $12,000 of revenue, $12,000 of compensation to the child that is working for their grandparent. That $12,000 that is paid to your child, I'm talking to my child, pays no federal income tax, pays no payroll tax. So I, as a grandparent, have moved and shifted $12,000 of income from my company, and I get an expense for this because I'm going to charge. I mean, I'm recording the $12,000 that I pay my child as an expense. Okay, my child picks it up as income, but shows the $12,000 that they pay their child as an expense. The child pays no federal income tax because I'm paying them enough to where the standard deduction eliminates any federal tax. And because they're under the age of 18, they paid no payroll tax. Now, I know I got some questions on that. I've got to have some questions on that.
They're thinking of some questions on that, Michael. We do have some other questions.
Okay.
Please, this is from Rachel LaFall again. Please explain the umbrella business establishment where there is a main company that wants to have subsidiaries, all for profit.
Yeah, I've heard that concept before, and a lot of people have talked about it. Let's just say you have a main holding company. We call it NewCo. NewCo is the holding company. All right, you own NewCo. All right, but NewCo wants to get into different types of businesses. But NewCo does not want one business to impact another business. Maybe NewCo wants to get into the real estate business, so they create an LLC that is owned by NewCo. All right, and the purpose of this LLC is to invest in real estate. All right, so they invest in the real estate, and now the next thing that NewCo wants is a company that sells cell phones. So they create another entity, which is owned by NewCo, that all they do is sell cell phones, and a third and a fourth and a fifth and whatever. Okay, so now that's the umbrella concept. The ownership is who owns NewCo. NewCo then owns a number of other entities underneath it. NewCo is in effect the umbrella. Okay, why do you do that? Because if I'm selling cell phones and my company gets sued, I'm not going to affect my real estate company, or I'm not going to affect any of the other companies, because that's the whole purpose of creating a legal entity in some cases. You always want to segregate that out. And this is something, and again, going back to the theme of this whole talk, is what would a CPA tell you that QuickBooks will not tell you? QuickBooks doesn't care. QuickBooks, all you're going to do with QuickBooks is like debits and credits. Everything is going to come out. A lot of people get QuickBooks, and I'll get into this a little bit right now. A lot of my clients who now, try to do their QuickBooks on their own and then call me and they say, well, my books don't balance, so something is wrong. I mean, I got my bank account to download directly into QuickBooks, but now the balance in the bank is different than the balance in the books. What happened? Well, what they're not doing is they're not reconciling on a regular basis. I'm old school. I want to make sure that the balance in the books, I can reconcile back to the balance in the bank. Let me tell you what happens. Every once in a while, when you download stuff from the bank into your QuickBooks, it can double up or it can miss some of the transactions. The other thing that happens is QuickBooks is intuitive. It thinks that if you say that you paid Office Depot and you call that office supplies, every time it sees you paying Office Depot, it's going to charge you to office supplies. Well, what if you borrowed money from Office Depot and you paid Office Depot back on a loan that you had with Office Depot? When you paid them, QuickBooks thinks that it's office supplies, and in reality, what it is a payment on a loan that you have. You see what I'm saying? Is that you have to have someone to be looking at these transactions, understanding these transactions, and properly recording them. One of the statements that QuickBooks can create for you that nobody ever looks at is called the fund statement, or the statement of changes in financial position, which is the one that I love the best. You literally have 3 financial statements that a lot of us, well, actually 4. You got the balance sheet, you got the income statement, you got what we call the fund statement, and you got the changes in equity, the statement of equity. The one that is the most beneficial to me as an accountant is what we call the fund statement, the changes in financial position, because it literally reconciles the cash that you had before with the cash that you have now, and it breaks it down into whatever happened. For instance, people might have their books on what we call the accrual basis. And the accrual basis means I sell something to Larry for $10,000. I record $10,000 receivable from Larry, and I record $10,000 as sales. Well, I don't have the money because Larry hadn't paid me yet, because I gave Larry 45 days to pay me, right? Now, if on the accrual basis, it shows that I made $10,000, but in my bank account, I got 0. Okay? Now, what I really want to know is, did my cash account go up after I sold the $10,000 of sales to Larry? No. Okay, say I did that on December the 31st. And Larry paid me on January the 10th. The money came in January of the next year. But was that income? Or was that a reduction in a receivable that I had set up the previous year? The fund statement kind of reconciles all of that. It kind of cleans all of that up. It cleans all of that up, and it allows you to say, okay, how much cash did you have in the beginning? Here are all of the elements that can produce cash, and what do you have at the end? And this is the type of thing that, fortunately, I did have a conversation with a very smart person about this recently. It didn't say, the subject of this talk is not what would a bookkeeper tell you that QuickBooks would not tell you. It said, what did the CPA tell you? A CPA is different than a bookkeeper in this regard. CPA is trained to make sure that he is preparing financial statements that are both accurate and timely. And why does he do that? He does it because he knows that he has to give management quality information on a real-time basis so that that manager or that owner of that company can make decisions accurately. A bookkeeper will just do what you want them to do. They will keep your books. They will give you no information on how to reduce your tax liability, how to create an environment where you can literally hire your children, how to decide which legal entity you want. Whatever legal entity that you have, a bookkeeper will go with it. You got a sole proprietorship, no problem. You got an Escort, no problem. You got a C Corp, I got you. No advice other than this is a debit, this is the credit. I put this in this box and I took it out of that box. That's what they do. Okay? And so if you want a bookkeeper and you want it, and the objective of what you're trying to do is to minimize your expenses, then get a bookkeeper. If you want a CPA, then pay the CPA, because that's a professional. That person is going to give you more than just the debits and credit. That person is going to give you advice about your company. And and when you get ready, if you get ready to go to a bank to go borrow $10 million to do your project, take the bookkeeper with you. And when the banker have their CPAs in there asking questions, maybe the bookkeeper can answer, maybe they can't. You understand what I'm saying? Is that when you got a small business, and I tell you this out of experience, out of many, many years of experience, one of the biggest reasons that companies fail is because of that, because of the lack of understanding what their company is doing on a real-time basis. I can't tell you how many times at the end of the year, people will bring their stuff in a box and say, okay, do my tax return. So, well, how much money did you? I don't know what I made. You know, well, what are your expenses? I don't know. It never fails for me to see how you can operate a business and not know on a real-time basis whether you're making money or losing money. Even if you're losing money, that may not be a reason to shut the company down. But you need to know what's going on a timely basis so that you can make decisions. We learn this when we take principles of accounting. We understand that as we go along, and we get it over years and years and years of seeing the impact of not knowing that.
Michael.
Okay.
Michael.
I'm through preaching.
Michael.
One more question.
That's a great job you just did on the compare and contrast between a bookkeeper and a CPA. I have a couple more questions. Which business structure are you suggesting for Black businesses, which 95% of us have no employees?
A LLC taxed as an Escort. An LLC taxed as an Escort. And it's very simple to get that done. Very simple. And why? Because then you can, and this is a great thing, because now you're taxed as an S-Corp, you can pay yourself a salary. And the reason that helps a lot of small businesses is one of the worst things that happens is when people don't make their estimated tax payments. Okay? If you have an LLC for which you can't pay yourself a salary, and all of the income that the LLC earns really comes to you, I have clients that I've come in and I have to give them the bad news that they owe $30,000, $40,000 tax liability. And I tell them that's not for federal income taxes. That's because of payroll taxes that you didn't make those payments throughout the year. But if you're paying yourself a salary and you get set up with, say, ADP, or you do the Intuit thing with Quickbooks, you're making your payment, you're making your tax payments as you make payroll. You're making every time you pay yourself a paycheck, you're taking the taxes out and you're remitting those taxes to the Internal Revenue Service on a real-time basis. Now, let me tell you something. Don't play with remitting those taxes. If you have employees and say your employee makes $1,000, but what you really pay them is say $825 because that other $175 was payroll tax, and then you have to match, their Social Security and Medicare, and you don't make those payments to the Internal Revenue Service, that's what will kill a lot of companies. I have had dental offices literally get killed because they didn't make those payroll tax payments. And the reason that people don't do it is that here's what happens. Let me give you an example. I start a new company. I'm going to sell widgets. All right, I'm going to sell these widgets, and it's going to take me a month to make the widget, and then I'm going to sell it to somebody. I'm going to use Larry again. Okay, Larry, I'm going to start my business on January the 1st. I'm going to hire my people. We're going to create widgets. It's going to cost me $30,000 to make the widget, but I'm going to sell it to you for $50,000. I'm going to make a nice profit, right? So through the whole month of January, we're making the widgets. Now, my people get paid on a bi-weekly basis, so I got 2 payrolls to make before I made a dime, right? So when I've got the widget already on February the 1st, I've got $30,000 that I've already spent to make the widgets, and then I sell it to Larry, and I tell him, look, you can pay me in 45 days. In the meantime, I'm gonna make some more widgets in February. Well, but before I get a dime, I have spent $60,000, $70,000. Most people that start businesses don't think about that. You know what they think about? I can make a $30,000. I can spend $30,000 making widgets that I can sell for $50,000. I made $20,000. The question isn't what you made; it's when you made it. Most people don't do cash flow, and what can a CPA do for you that QuickBooks won't do for you? I can sit there and I can tell you how this money is going to flow, and I can tell you how much working capital you need in order to do what you're trying to do. And it doesn't matter whether it's widgets, whether it's a dental office, whether it's a doctor's office. I don't care what you're doing. It's the same concept. It's the same. Doctors, they have to file insurance claims. And if you want to have some fun, go file insurance claims at a dental office and get the feedback from the insurance company telling you didn't cross this T and dot this I. I had and quit trying to do things that you don't know how to do. I had a client, a doctor, very sharp young lady. She decided that she didn't want to pay for the billing service. So she decided that after she finished all of her rounds with her patients, that she would work her files in the evenings. Well, a couple of evenings happened and she didn't work them. She waited and waited and waited, and finally she got around to it. She lost $250,000 from Medicaid and Medicare because they were too late. Stay in your lane. Do what you can do. Go anticipate the cost of having a sound team with you. That's part of the cost. If you can't make money with that cost in it, then you shouldn't do it.
Great point.
But you can do all of this stuff. Actually, you can operate on yourself if you want to. Just go look on the internet. You got an appendicitis, go ahead and get a knife and go after it.
Michael, we have a couple more questions. From Deborah Davis, family limited liability. Can you explain? Can you explain?
A family limited liability structure is mostly designed for wealthy people. And I learned this because when I was working overseas, one of our investors was the nephew of a very, very wealthy person. And every time that he would put money into our company, the money didn't come from him. It came from a family limited partnership. And so we would ask him, why did he do that? And he told us, he said, look, I want to put as small a target on my back as possible. A family limited partnership is designed to protect the family and to create a way where you can literally control everything. You can create a family limited partnership, like I said previously, where you are the general partner and say you own 1%. You own 1%. I had a structure one time where I had a family limited partnership. Each of my children owned 15% of this family limited partnership. 54% of the family limited partnership was owned by a living trust where I was the trustee. My brother was the co-trustee. If I died, my brother would become the trustee. That would be a quick claim for my house to go into the go into the living trust, and each of my children equally own part of the living trust. So in effect, I own 1% of what I had. My children own 99% of what I had. But I controlled everything because as a general partner, I literally controlled everything. And as a trustee on the trust, I control that as well. You create these kinds of things to minimize liability.
Michael. So I think this question was in regards to a business operating and they decided they wanted to start a totally separate business.
Mm-hmm.
And the recommendation was perhaps to set up a different structure for that different business. This is the question.
Yeah.
This is the question.
Mm-hmm.
So the setup would have the new company as the owner.
Mm-hmm. Mm-hmm. So the new company is going to own the old company?
That's not clear. Actually, Rachel LaFall, clarify if I'm not getting your meaning. I'm thinking that he's really asking, did the first existing company be the owner of the new company? Or do they have their own? Are they kind of separate?
Well, what you can do is like this. I had a plumbing company, and we got around to creating the structure that I just described for you in the middle of the year. Well, from January 1st to the time that we structured the new entity, it was the old company, right? So the old company had all of the tools and all of the receivables and all of the things that the old company did. When we created the new company, what we did is we contributed the assets and if liabilities over to the new company. For instance, let's just say that the old plumbing company had $100,000 worth of tools. Well, the new company, when he created it, he would contribute the tools, and the new company would record on its books as an asset $100,000 of tools and show $100,000 of owner's contribution. Okay, so now the new company has the thing. Now the old company had receivables because of work that it had done. We let that clear out. In other words, all of the outstanding receivables that the old company had, we allowed those payments to come into the old company. Because when I do the tax return, I have to do a tax return that literally has two entities. It had the old company from January 1st to the date that we created the new company. And then I had the new company from its incorporation date through the end of the calendar year. There was only 1 year of this craziness, so it's not terrible. A CPA can handle that.
So a piggyback to that question from Ms. Davis, the Family Partnership LLC, can Mr. Porter speak to this LLC and its advantages?
The family partnership, but well, okay. I think we're kind of like combining a bunch of things. And limited liability company can obviously be owned by someone and their spouse. Okay. Now, the only thing that I have to, and I got to get clarity on it because I've spoken with a legal counsel about this. If I create an LLC, and this is how the lawyer talked to me about this. If I create an LLC, technically, I have complied with the family health situation in the Internal Revenue Service. It's an LLC. Me and my spouse own the LLC. We employ our child who is under the age of 18. Everything seems to work. But what if that LLC petitioned the Internal Revenue Service to be taxed as an Escort? The question that I had for the attorney was this. Under the law, it states that if it's sole proprietorship or partnership in which each partner is a parent of the child. Well, an LLC by its nature is a partnership. So if I legally created a partnership, the fact that it's being taxed as an Escort, does that negate my ability to hire my child? Okay, because an S-Corp, if I created an S-Corp in the beginning, that's an incorporation, and I can hire my child, but I would have to pay payroll tax. You see what I'm saying? So the lawyer said the legal structure of the entity was a partnership. The fact that it is being taxed as an Escort does not negate the legal structure, and therefore allows you to do what a partnership can do. I'm still a little foggy on that, but that's what the lawyer said. But
okay, next question. K. People, does the grandparent have to pay taxes on those expenses that she pays to the parent company? I think that's what you.
no, that's a deduction for the grandparent. The grandparent is charging an expense. The grandparent has hired their child to do something. They hired their child to provide an employee who happens to be their grandchild to come into their business and perform some service for them. So that cost that the grandparent pays their child is an expense and a deduction on the grandparent's tax return.
Okay.
Taxes on it. They're literally funding their instead of giving their grandchild 12. Okay, let's assume that the grandparents are really, really, really wealthy, and their marginal tax rate is 37%, and they're paying, they're paying they're literally paying 40% in taxes. Okay, so they want to give their grandchild $12,000. If they give their grandchild $12,000, they have to have $20,000 pre-tax to give their child $12,000. Why? Because 40% of that $20,000 would go to the Internal Revenue Service. You get it? Now, I don't know about you, but if I could save $8,000, that would be kind of cool. And even if they paid the child more than the standard deduction, the tax rate for the child is maybe 10 or 12%. Would you rather pay 10 or 12%, or would you rather pay 40%? You see the point?
Mm-hmm. From Colleen Milligan, to confirm, are the entities protected from one another if they are LLC, corporation, etc.?
Confirm that they're protected from one another. In other words, we're talking about that umbrella situation where I got several companies.
Correct.
If when you ride down the street and you get into an automobile accident, and on the side of the big truck that hit you was Newco LLC, you're going to sue Newco. Okay, you're not going to sue the person that's driving it who happens to own Newco. So his personal assets, and this is another thing. This is something else that a CPA will tell you that QuickBooks won't. The thing that you are operating on is a thing that is subject to litigation. So I got a company, I'm making a lot of money, and I'm looking, and my financials look great, and my balance sheet look wonderful because I'm leaving all of the cash inside of the company, right? Because I don't have a CPA, I don't know how much cash I need to have in my company, so I leave more in there than I need to. But one of my employees does something, and my company gets sued because I left all that money in my company, and that's the entity that's being sued. That amount of money is now subject to that litigation. Okay, so what I want to keep in my company is enough money to operate, but no more. I want to get the rest of it out, because the object of creating the legal entity was to provide liability protection. Now, if I have two different companies, the one company that gets a lawsuit against it does not impact the other one that doesn't. That's why I have two different companies that are doing two different things. I could have just one company that does multiple things. And if I did that, then everything inside of that one company is subject to the litigation. Okay? Because I have two companies, each of the companies standing on its own and has its own legal liability. If one gets infected, it is not infecting the other. Does that make sense? You see what I'm saying? Okay.
From Donita Smith. I have an LLC that also has a nonprofit sector that is operational November 19th to March 2020. The LLC is a cosmetology and barbering school startup. Should I restructure?
That's a strange. Okay, so she has an LLC that has a nonprofit. Nonprofit what?
She said sector.
What does that mean? I don't understand. What do you mean nonprofit sector?
Donita, can you clarify?
Can you explain that? I mean, is it a nonprofit? Because you have to get the Internal Revenue Service to designate that entity as a nonprofit. Either it is or it isn't. So you can't. What she's describing is a hybrid that I've never heard of before.
Okay. Why don't
now you have a company that does some good things for people and say, okay, I want to, I got a cosmetology, I'm gonna, help out some. I mean, that's not a nonprofit.
So we do have a couple more questions, but can you move forward with your presentation and then we'll get those before we wrap up?
Well, I'm about, where are we now? Ooh.
We got about 25 minutes. Still.
If it's okay for us to just start answering questions right now.
Okay.
That's really
okay.
The hiring your child, I think, is a key place to stop, because that, I'm telling you, is awesome and something that a lot of people aren't doing. And again, IRS.gov, type in the search engine, family help, and everything that I just told you will be there. I just checked it.
Yeah, it's pretty awesome what you're saying. I mean, I've attended a couple of seminars where they talk about business structure, and not only from a standpoint of establishing the right business structure for your business, but to have additional business structure to enhance your tax liability, to reduce it or to defer it. Like you're saying today, this is invaluable information that you're giving, so we appreciate it.
Yeah.
So from Rachel LaFall, would the main umbrella company be the owner of all of the subsidiaries?
Yes.
Okay. What is the max that they, from Colleen Milligan, what is the max that they can pay a grandchild?
Whatever they want, but if you want the grandchild to pay absolutely zero taxes, pay the grandchild just enough so that when the grandchild does a tax return and they get the standard deduction, because no longer are personal exemptions allowable on tax returns anyway. But when the grandchild does a tax return, what you do is there's a question on the software that says, are you being carried by someone else? They'll click that box. So you pay the grandchild enough to, if you want to reduce the tax to zero, pay them just enough to where that standard deduction reduces the income earned by the grandchild to zero. If you don't mind paying a little tax, remember, the first almost $10,000 that the child earns beyond the standard deduction is taxed at around 10%. So, you could either go to zero or you can go to a very, very low tax payment by the child, but no payroll tax is paid by the child if the child is under the age of 18. Now, the grandparent isn't paying the child. Remember, the grandparent isn't paying the child. The grandparent is paying their child, who's paying the grandchild.
Okay, awesome. Colleen Mulligan, what are the tax advantages or disadvantages to having multiple LLCs versus one company?
Well, I think it kind of relates to the other question that was asked. There literally aren't. I mean, if you have multiple LLCs, the reason that you're doing it is what we said, is you don't want the activity in one business venture to impact the others. Okay? But when you do your tax returns, all of that stuff is going to aggregate to the one owner's tax return anyway. All right, so they're the same in that regard. But the reason that you have multiple legal entities is to, again, separate them to have those activities not impact anything, because everything is subject to litigation. So you have a hairdresser place and you mess up somebody's hair and they sue you, or they walk in your business and there's a wet floor and they slip and they fall. They want to sue you. You didn't cut their hair right and they want to sue you. All of the different things. Everything is subject to litigation, right? Almost anything that I could imagine. Being a CPA, somebody wants to sue me. That's why I got to have a professional liability insurance.
So, Michael, what is the timing, right? If you're a startup, you mentioned having your professional team in place. So that includes, of course, the CPA or accountant, whatever you're going to start with, but also your insurance professional, your banking professional, your attorney. What is the timing? I mean, a lot of folks, they wake up, they want to start a business, they have this great idea, they want to make money, they just want to get out there and make money, right?
Right.
Do they want to get out there and start making money and have something like that happen, right? You have a liability, you damage something, you hurt somebody, but you didn't put that team in place that you mentioned. What's the time? What's the real timing of bringing on these professional partners?
Well, normally when you're going to start a business, one of the first things that you want to do is do a business plan. Part of the business plan is going to be an analysis of your competition. It's going to be, obviously to discuss what it is that you're trying to do. But it's also going to include, part of the business plan is going to be financial projections. Those financial projections, if done correctly, will give you as the business owner kind of an idea, a kind of a picture of where you should be as you progress along in this business venture. So before you start the business, either you have to do that, or either you have to go out and hire the people that can do that for you. It also looks better when you walk into the bank to get a line of credit or something like that, that you have something that was professionally done that gives the banker the picture of what you're going to do with the money that you're going to borrow from them. So this is when I put on like I said, I'm a CPA and also a certified financial planner. So I'm a little bit different than most just CPAs or just certified financial planners. I kind of start looking at that from the beginning. In other words, like right now, I have doctors that are, doctors are cool because they just don't like to just practice. They always want to get into different businesses and stuff like that. So they want me to basically do their accounting, but they also want me to provide all of the services that they need as a financial advisor. All right. And so everything that we do is done in light of that. For instance, if they wanted something, they just bought a house and they say to me, if something happens to me, I want the house to be paid for, my family to be okay. And then they say, well, can I pay for the insurance through the company? I said, well, yeah, but we're not going to deduct the payment for that premium. And they say, why not? Because I said, if your family gets paid, you want that to come back to them tax free. I said, oh, okay, that's fine. But the cash can actually come from the company. Yeah, absolutely. It's just I just call it owner's withdrawal. It's all balance sheet. It has nothing to do with the income statement. So to answer your question, as early as possible. And I like to think that my practice is different because, again, I'm not just going to save you $10,000 in taxes. I'm going to hopefully tell you how to take that $10,000 and invest it and turn it into $100,000 over time. Okay, so I'm always looking at, Originally, I became a CFP to augment my accounting practice. Now, I augment my financial planning practice with my CPA practice because I love helping people accumulate wealth. Okay, and if we ever had a tech talk about financial planning, count me in.
So,
Count me in.
so Michael, can you think back a little bit about our conversation on Saturday and establishing insurance and the timeliness and what could be the ramifications of that as well? Not only from a solely business standpoint, but because this is again is what will your CPA tell you that Quickbooks won't, but from a legacy standpoint. That you remember that scenario you talked to me about?
One of the things that I've learned by being working as a financial advisor is how to accumulate wealth. How is wealth actually accumulated? And tell people a few things. Walt Disney started using the cash value of a life insurance policy that he had. Michael Dell of Dell Computers pays $1.2 million a year in premium on his life insurance. One of the things that I think that we need to look at is how to raise capital and how to accumulate capital and how to basically become your own banker. Okay, a lot of people get dressed up and they get all sweaty and nervous about going and asking a bank to loan them money, right? But if you had a proper financial plan in place early enough to where when you got ready to do something, you literally didn't have to do that. All you had to do was borrow from yourself, essentially. And if you borrow from yourself, what happens is you have what they call an unstructured loan. The object of an unstructured loan, or the reality of an unstructured loan, is that if you don't feel like paying it, you don't have to. You're not going to foreclose on yourself. Okay? And I was talking to Larry about this. There was two great families in the turn of the century that were the wealthiest families in the world, the Rockefellers and the Vanderbilts. And they literally they would be equivalent they would be the richest people in the world, if you bring their monies up to today's current values. Well, the Vanderbilts, they understood wealth and they created wealth, but they passed wealth down to their family members the traditional way. When they died, they gave it to a family member. Now, because of taxes and because every once in a while they would give it to a family member that was not capable of handling the situation, that wealth was severely diluted. The Rockefellers, on the other hand, and we go back to this family limited partnership situation, rather than passing it down, what the Rockefellers did is they put all their money into one of these family limited partnerships or a trust. Okay, they put it into the trust. And if you wanted to start a business or go to college or get married or buy a home, rather than going to the bank and you were a member of that family, you went to that trust and you borrowed the money from the trust. And the way that it worked is you had to pay it back. However, you also had to get a life insurance policy on you that was owned and paid by the trust. So that if you paid the loan back, great. It just, it was paying it forward and your subsequent family members would benefit from that. But if you didn't, oh, well, the life insurance would kick in because that was one thing that we all have to deal with, And to this date, the Rockefellers' wealth remains some of the highest in the world. Well, in terms of legacies, and I was telling, there's this family of Indian Americans that live here in the States that understood insurance 80 years ago. And it's 45 members in the family. And though that family owns a grocery store and a gas station. And the family members always go to that grocery store, to buy the stuff that whatever that they can't get from HEB or whatever, and they go to the gas station. But no one in that family has to work. Why? Because here's what they do. Every time a child is born in that family, they put $1 million of whole life insurance on that child. But at the same time, they give that child and make that child a beneficiary of one of the older members in the family. Say somebody that's, say, 60 years old. So the child at 0 age gets $1 million of insurance on them, and they get, say, 25% interest in the 60-year-old's insurance. Now, the 60-year-old, by the time they're 60, might have $2 or $3 million worth of insurance, might have $400,000 or $500,000 worth of cash value in it. All right. So let's go forward. Let's go 30 years into the future. Now, I'm not going to say anything that's, controversial or anything like that. But that child, let's say that child is in medical school at age 30. That child is in medical school at age 30. That 60-year-old is now 90 years old. Now, let's get real. All right. Something happens to the 90-year-old, that 25% payout to that 30-year-old child that got it when they were a child is enough to not only pay for the loans that they got to go to medical school, but also to set them up in practice. And the reason that this thing continues to work for this particular family is because they never distribute 100% of the death benefit. They only distribute 50%. They use the other 50% to pay the premiums on those new children that are coming in to play, and it continues to focus, and it's a legacy play. Okay, and I have been working on this for a while to see if it could be done, and when I did, it does work. Okay, that's more getting into financial planning. That's more getting into how to do something so unique and so beneficial that it not only helps you, but it helps to create a legacy.
Thank you, sir. I wanted to piggyback on the banking relationship aspect of, these professionals you need to pull together and how critical that is. Once you decide you want to start a business, it's no longer just going to see the teller to cash your check or go through the ATM when you want to withdraw money. It's about building a banking relationship. And so we're going to cover this in a much broader topic, building banking relationships, on tomorrow. So make sure you guys come back for that. But that aspect right there is one of the reasons that a lot of small, we're keeping it real, we're keeping it 100 with you today. That's one of the reasons that a lot of small businesses were denied PPE, right? Or denied a loan. If you want to start a business and you're going to need funding, you should have began talking to the small business, not the teller, not even that dude that sits across the way in that office over there. It's the small business development person of that bank. He may not even have an office in that branch, right? And so I just wanted to mention that because I'm not sure that we totally understand that you've got to have a relationship with all of these folks, the insurance person, the CPA, the lawyer, the banker, to where as needs come up, as growth come up, you want to scale your business, you want to get a loan, you have a relationship with these people, right? To where they know you, they know your business. Don't just go to them once a quarter. And that was going to be a question for you, Michael. How frequently should business owners interact with you? Is it just around tax time, once a year? Is it quarterly when taxes are due? I mean, you tell me.
You can do it one or two ways. I have contracts with clients that provide them services on a monthly basis, and I see one of the questions in the chat section that asks, what do you how much do you need to budget for a CPA? I mean, obviously that's a subjective question, and it's based on what, different things. For instance, some of the clients that I get, I might not charge what I would if I didn't have another relationship with them, because a lot of the clients that I'm dealing with, I'm doing financial planning for them. So my fee may be, say, $500 a month or something like that. And in that case, I'm meeting them every month and providing them financial statements. I'm there to explain to them what those financial statements show, and what and to discuss with them various things that they want to do. And they can talk to me about literally anything. Some clients are smaller. They want to meet on a quarterly basis. They want to basically try to do the work themselves. And I go and I see them 4 times a year on the quarters, making sure that they're making the estimated tax payments correctly, making sure that their books are straight because they've worked on them for like 3 months, and I need to, go straighten things out and that type of thing. I might charge a smaller fee for that. But again, in each case, I'm trying to get them to understand that my role is a little bit different than a regular CPA, because I'm going to give them advice with respect to financial planning. I'm going to find out what they're doing. You just had a child, you just changed another job, you got another client that is coming in. All of the different things that would give me information in order to assist and help them. So, that's how I would do that.
Michael, I think there's only one other question that we didn't cover today. I'm glad you picked up the one on having a budget for CPA. And it is from Rachel LaFall. Additionally, how does reduction in payroll, some business reduced to none, affect payroll tax liabilities in relation to having an LLC or an Escort?
Well, okay, here's what happens with an LLC. Like I said before, an LLC, if I own the LLC and I have my company is an LLC, when I earn income, I don't pay myself a salary, right? I can't, because I'm what they call a sole member LLC owner, and I do my tax return in Schedule C, okay, as a sole proprietor. My taxes are done as if I'm a sole proprietor, but I have the legal protection of the limited liability company. All of the income that is earned from my LLC is taxable to me, because it comes to me off of that Schedule C. All right. If I had, and it's been so long, I just haven't changed it. If I was structured as an Escort, then I would pay myself a salary, and then I would have to pay payroll tax I think it's the 15th of the month following the month in which I paid payroll. Now that particular structure is the thing that gets a lot of people in trouble. If I do payroll this month, and I've got employees, and I'm holding out money for their federal tax and their payroll tax, and then I gotta match the payroll tax, and I only have to pay the payroll tax for them by the 15th of the following month, you can see where if I got into a cash crunch, maybe I wouldn't make that payment. Okay. And so I don't recommend that to clients. I tell clients, okay, if you do payroll, pay the tax immediately. Pay it immediately. Don't get into the habit of taking as much time as they allow you to take, if you understand what I'm saying. That's why I have a relationship as a CPA with say ADP. ADP charges me a very small amount, which I give to my clients free. In other words, I'm the client. They hit my account they charge, this is what they charge, $60 a month plus $1 per payroll that they pay. And they can do all of this stuff. They can do direct deposit. They can put a check in front of you. They can give your client, your staff a check, whatever. So if you had like 10 employees and you paid them twice a month, the cost would be $60 plus what? $20, $80 a month, plus a couple of dollars in taxes. Okay. That's what it costs me. So I pass that to my clients. You couldn't get that if you went directly to ADP.
Okay, so Rachel says that there was actually a part 1 to that question. Sorry, Rachel, that I missed that. But it's in regards to the impact of the pandemic on small businesses, and she wanted to know, how does the PPP affect payroll taxes? And Michael, we've got a couple minutes left, so be thinking of how you're going to share your information, because
Yes.
they're really wanting that. How does PPP affect payroll taxes, sir?
PPP, what it was designed to do was, you have to spend a certain amount of the PPP loans to pay your employees. If you had people that had like my clients that are the doctors, they were actually able to get PPP loans. And the reason that they were able to get PPP loans was the structure of the companies that they set up. They actually had compensation. And the way that it worked is you get the monthly compensation. Say their average income for 2019 was, say, $30,000. Okay, that was the average income. They were able to get 2.5 times that as a PPP loan. So they were able to get what, $75,000. Okay. Now, there was a congresswoman that has put a petition into the Congress that is asking for anybody that got loans less than $150,000, they were going to forgive them. Now, here's the deal,
Michael.
Yeah.
I'm sorry. Can you either put your contact? We got 2 minutes left. Put your contact information in the chat, or can you share your screen, one or the other, while you're talking?
Okay, I'm gonna type it in this deal right here. Is that okay?
That's great. Sure.
Okay. So now you see my name. Okay. So now I saw how it comes out. My number. That's my number.
I could really listen to this
Yes, you can.
gentleman
yes, you can.
all day. He has a wealth of information, and as you can plainly see, he's passionate about what he does. He wanted to be on this event and share his information. Michael, we thank you so much for sharing. We thank everybody for attending this session of We Mean Business. And with that, we're all done. Thank you so much.
Thank you.